why rate cuts may not be enough, and why QE could return. Despite growing market expectations for Federal Reserve rate cuts, structural cracks in the U.S. bond market, driven by persistent fiscal deficits and a ballooning national debt, suggest that rate reductions may no longer be an effective tool for lowering Treasury financing costs. Bond yields remain relatively elevated, and investor demand for Treasuries is waning, signaling that monetary easing alone may do little to relieve the government's funding pressures. Looking ahead, the case for another round of quantitative easing, QE, is gaining traction, potentially as soon as 2026. Should fiscal needs escalate and global risks, such as a potential sovereign debt crisis in Japan, intensify, the Fed may be compelled to reintroduce large-scale asset purchases to restore market stability and contain borrowing costs. What does QE mean for the US dollar? Historically, QE has exerted short-term downward pressure on the dollar as expanded dollar liquidity fuels capital outflows to other markets. During previous QE episodes, the US dollar index experienced drawdowns ranging from 2.6% to 15.3%. However, as QE programs near their conclusion, the dollar typically stages a strong recovery, driven by expectations of liquidity tightening and increased demand for dollar-denominated debt repayment. See arrows indicate turning points. Looking forward, the dollar's trajectory is likely to fluctuate between the competing influences of monetary easing and safe haven demand.
Thanks for watching. That's all for today's update. Don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis. See you next time.